Remember when refinancing, basically cashing out on your home's equity to invest, was a big thing for Toronto real estate investors just a few years ago? Back then, interest rates were at an all-time low, and so it was practically free money, and property values were soaring during the pandemic, which also helped with big refis. But then things took a turn when interest rates spiked, combined with real estate prices dropping quite a lot. Now, another shift might be happening again soon. With fixed interest rates dropping by over 1% in just recent weeks and variable rates also coming down likely in 2024, refinancing might make a comeback this year. Lower interest rates now could mean that you can borrow more money, opening up more opportunities for real estate investing for you. So in this video, let's take a closer look at refinancing Toronto real estate. Why real estate investors refinance to grow, how to refinance to invest, and also take a closer look at how more refinancing in 2024 could change up the Toronto real estate market. If you're new here, I'm Samantha Chan from Elevate Realty, and our Toronto real estate brokerage wants to help you make smarter real estate investing choices in Toronto. Don't forget to like and subscribe if you enjoy our content. Let's begin. Let's start with a simple example. Imagine you own a $1 million home with $500,000 of equity in it and a $500,000 mortgage. If property values grow by 3% a year in line with long-term inflation, then you end up growing your wealth by $30,000 annually. Now, keep in mind that this is pretty conservative compared to Toronto's average appreciation of 7% a year over the past 2 decades, but we generally like to play it safe with our projections. Now, making $30,000 a year is pretty good without doing anything, but let's take it up a notch by adding in refinancing to invest in another rental property in Toronto. There's $500,000 of equity in your home, and you can go back to the bank to pull out another, say, $250,000 if you qualify for a bigger loan. And after you do this, you end up with $250,000 of equity still in your home, a $500,000 mortgage on your own home, and a new $250,000 mortgage that you can use to buy another rental property in Toronto. Now, what we would do here is use that $250,000 as the down payment, closing costs, and renovations for a Toronto duplex. You would make money from this rental property from rental income, which comes in the form of cash flow each month with net rents after you pay for all of your operating expenses and your mortgage payments. And you also make money from mortgage pay down by paying down your mortgage each month. Add that to the values going up each year on the property, and even after you factor in taxes that you pay out on your investment, you still make another $24,000 per year after taxes on the rental property. Add this to the $30,000 that you get from your own home, which is tax-free because it's your own principal residence, and you're making $54,000 a year on both properties combined, almost doubling what you would be making if you just let the money sit in your home. This is why debt isn't always a bad idea and why we like to refinance to invest. It does help you make more money on the equity of your home, but we want to put a big asterisk here because you really need to make sure you can manage cash flows from bigger monthly mortgage payments. And this is why multiplex investing in Toronto stands out, because better rents do help you pay for all of those outgoing payments each month, including your mortgage and your operating expenses, making it a much lower risk way to refinance and invest. And as you create more bedrooms and units in the home, not only will you get better rents and cash flows, which can further lower your risk, you might also increase your home's value on top of what you paid in and possibly help you refinance sooner if that's in your plans too. And that leads us to the next thing to talk about. How can you maximize your refinancing? Well, the passive way to do this is to wait patiently for prices to go up naturally over time. But many real estate investors prefer a more active, hands-on approach, making real estate investing a lot more interesting. Now imagine you have a $1 million property that needs $150,000 in upgrades. So basically you've invested a total of $385,000 into the property, but here's the exciting part. If the property is worth $1.3 million after the improvements, that's a $300,000 increase in value. So you can go back to the bank afterwards and refinance 80% of the new value, and that lets you take out an extra $240,000 in cash to reinvest. And this is how a lot of real estate investors get a faster lift for refinancing. Now, let's say we've got enough equity to think about refinancing. How do you actually go about refinancing these days? Well, in the past, many investors did use HELOCs, home equity lines of credit, to cover the down payment and closing costs, but in more recent months, the borrowing room here has dropped from 80% to 65% of the property's value, and that can impact how much you can pull out here. And the other thing is that HELOC rates are very high these days, hovering close to 9%, which is a lot more than the current fixed rates, approximately 5%. So from a cost of borrowing standpoint here too, it's also starting to make less sense. So another way you can do it is to break your current mortgage and then refinance it altogether. But that also comes with penalties for breaking your current mortgage. And if you have a pretty good rate locked in, you might be paying more when you refinance at today's higher rates. The other thing you have to keep in mind is that if you're refinancing your home for investing purposes, you need to have a clear paper trail of how the borrowed funds are used for investing. And that likely means that you need to clearly separate your home's mortgage with your investing mortgage. We're not accountants, so we can't advise specifically on this front. So make sure you check with your accountant before diving into refinancing for investing. A potentially better way, in our opinion, to approach refinancing these days is to take on a blend and extend. Here's how it works in a nutshell. Basically, you would keep your existing mortgage terms and then add a new leg to it with today's interest rates and terms. Now, many banks will give the new leg a new contract, making bookkeeping clearer here too. There will be no penalties when you're doing this because you're not breaking any mortgages. Payments work just like a regular mortgage where you need to pay interest and principal back each month. And because it's like a regular mortgage, you can maximize your refinancing at 80% of your property's value too. Now, zooming out, we generally know why refinancing isn't as popular these days. Interest rates shot up, causing payments to increase and making qualifying tougher. Property values also dropped, making it even tougher to pull out equity to refinance. On top of that, higher borrowing costs and generally more fear push more people to the sidelines when it comes to investing. But here's the thing. With fixed rates already coming down over 1% and variable rates likely coming down as well later on this year, we're expecting a gradual recovery for refinancing. And once more people take on refinancing to invest on top of just other people stepping out of the sidelines to buy real estate as well, this could help boost values even more. And eventually, these higher property values will give more room for refinancing from more equity. And then all of this could start to build quicker upward momentum for Toronto real estate. If you are looking to refinance to invest in 2024 and you're looking for the best real estate investing options in Toronto, we can help you navigate through all of these steps. We're not your typical real estate sales brokerage. Instead, we like to use numbers to make better real estate investing decisions in Toronto. And that can mean looking for stronger investments with positive cash flow, thinking about risk management, and looking for ways to boost returns like value add renovations and gentrifying areas. If you do want to discuss your private real estate situation with us, just head over to this link to book a time to chat. You can also check out more content on our website or find us on social media. And if you haven't done so already, please like, subscribe, and share this video if you think someone else might like it too. Thanks so much for watching, and I'll see you in the next video. Bye.